The 2025 Rio Summit may mark a subtle but significant shift in global economic coordination. Leaders from major emerging markets, including Brazil, India, South Africa, and China, gathered to discuss how their economies can take a more active role in shaping international financial norms and development frameworks. Rather than challenging the existing system outright, the tone of the summit focused on diversification, of trade, of finance, and of strategic partnerships. There was a clear emphasis on increasing cooperation within the Global South and exploring mechanisms for greater self-reliance, particularly in trade settlement, infrastructure investment, and development lending. One of the more closely watched outcomes was the renewed support for alternatives to traditional dollar-dominated trade systems. The new development bank, originally launched by BRICS nations, received new commitments to expand its role in regional infrastructure projects and financial coordination. Some countries also expressed interest in experimenting with local currency trade arrangements, particularly in commodities and bilateral agreements. For global investors and economists, these developments are worth noting, not because they replace current systems, but because they may coexist alongside them. In practical terms, this could lead to a more complex and regionally nuanced global financial landscape. A second theme was the growing importance of commodity strategy. Brazil and several resource-rich nations discussed more cooperative frameworks for managing the export of key goods, including lithium, agricultural products, and rare earth elements. While the specifics are still evolving, the intent seems to be about increasing stability and ensuring fair value, rather than imposing restrictions. If implemented thoughtfully, such coordination could actually reduce volatility in some markets. So, what are the implications? First, investors may want to keep a closer eye on emerging markets, not just for growth potential, but for how they're shaping new economic alignments. Countries seeking more balanced partnerships may also present unique investment opportunities in sectors like infrastructure, agriculture, and green energy. Second, central banks and financial institutions will likely be monitoring any shifts in cross-border settlement practices, especially as more countries test limited local currency arrangements. It's not a wholesale move away from the US dollar, but it does reflect a broader desire for optionality in trade and finance. Third, supply chains tied to strategic resources, especially those needed for energy transition technologies, may see more structured planning from producer nations. For industries in the West, this could mean more transparent sourcing partnerships and perhaps new rules around long-term contracting and joint ventures. Importantly, none of this suggests a sudden economic upheaval. Rather, it reflects a more collaborative and multipolar approach to global growth, one that places a bit more weight on shared development goals and regional resilience. In the years ahead, the real test will be whether these ideas take hold in policy and practice. But the Rio Summit has made one thing clear: emerging economies are not just participants in the global system, they are increasingly helping to shape its future. Subscribe for more. Finally, it's important to note the softer but equally significant aspect of the summit: the psychological shift. The Global South is no longer asking for a seat at the table, they are building their own. This reframes geopolitical investment strategies and calls for a more nuanced understanding of risk, influence, and return in the multipolar world now emerging. To be clear, this isn't the collapse of the current system, but it is a credible alternative forming in real time, one that economists, investors, and policymakers can no longer afford to ignore.